Your bank tells you they hold your money safe. That's technically true, but it's a wildly incomplete picture of what's actually happening inside the building. Banks don't store your money, they use it, and the 5 ways they use it are the reason your savings account pays you almost nothing, while the bank itself makes record profits. Once you see the machine, you can stop being its cheapest input. The story most people know goes like this. You deposit money, the bank lends it to someone else, and the bank keeps the difference. That gap between what they pay you and what they charge a borrower is real. It has a name, net interest margin. And across all US banks, it currently runs around 3.4%. That spread is roughly 60% of how a typical US bank makes money, which means almost half of bank revenue is something else entirely, and that something else is where the story gets interesting. Here's why this matters for you, not just for shareholders. Every one of those revenue streams is funded, directly or indirectly, by your checking account. Understanding the machine means understanding why free checking isn't free, why your savings rate is what it is, and where the real money is moving. Quick benchmark. A typical big bank savings account today pays around 1/100%. A high-yield account at an online bank pays north of 4%. On $10,000, that's the difference between $1 a year and $440 a year. Same dollars, same FDIC insurance. The gap is the price of not asking questions. Banks make money in 5 distinct ways, and they are not weighted equally. Let's walk them. 1. Net interest income. The classic spread. Borrow your deposits cheap, lend them out at higher rates. Mortgages, car loans, credit cards, business lines. Roughly 55% of revenue at the average US bank. 2. Service fees. Overdraft, NSF, monthly maintenance, wire transfers, out-of-network ATM. Around 15%. And we'll come back to the biggest one in this stack, because it's the single most lucrative fee in retail banking. 3. Interchange. Every time you swipe a debit or credit card, the merchant pays a small percentage to your bank. 1 to 2% each, billions of swipes a year, about 10% of revenue. 4. Trading and investment banking, underwriting, market making, advising on deals, roughly 15%, concentrated at the biggest banks. And 5. Float, around 5%, which sounds boring and is actually one of the cleverest tricks in finance. We'll get to it. Notice that fees, interchange, and float together are roughly 30% of revenue, and at some big consumer banks, fee income alone is larger than their entire net interest line. The right way to picture a bank is not a vault, it's a toll road. Every dollar that moves through the bank passes a series of small booths, and the bank takes a tiny cut at each one. You barely notice any single toll. That's the design. The money is in the volume, and the volume is you. Let's make this concrete. Meet Jordan. Jordan has a normal checking account at a major bank. Average balance, about $1,800. The account is advertised as free. In a normal month, Jordan swipes the debit card about 25 times for groceries, gas, coffee. Each swipe quietly pays Jordan's bank around 1 to 2% of the purchase. No fees show up on the statement, so the account feels free. Then on day 27, Jordan swipes for groceries with $11 in the account. The bank lets the $42 charge go through, then charges Jordan a $35 overdraft fee for the privilege. That single fee is more than Jordan's bank earned from a month of swipes, deposits, and float combined. Which brings us to the rules. Rule 1. Banks make more from your inattention than from your deposits. Overdraft and NSF fees alone pulled over $12 billion out of US consumers last year. 2 banks, Chase and Wells Fargo, took roughly $1 billion each by themselves. Here's the mechanic. When your balance is too low to cover a transaction, your bank has a choice. They can decline the charge for free, or they can approve it and charge you a fee. Most banks default you into the approve and charge version because the average overdraft fee is around $35 and the average transaction that triggers one is under $20. The bank's actual cost to front you $20 for 2 days is essentially zero. The $35 fee is almost pure margin. That's why it's the most lucrative single fee in retail banking, and why, even after years of pressure, the biggest banks haven't given it up. The fix is one phone call or one setting in your app. Opt out of overdraft protection entirely. With it off, a charge you can't cover just declines. Mildly annoying, zero fee. That single change can be worth hundreds of dollars a year, and federal law requires your bank to let you do it. Rule 2. The float. When you spend money, it leaves your account instantly. When money comes in, a paycheck, a transfer, a check, settlement can take 1 to 3 business days. During those days, the dollars sit in the bank's account at the Federal Reserve, earning interest. For them, not you. That gap is called float, and at scale, it's a real line item. Rule 3. Interchange. Every time you swipe your debit card, the merchant pays your bank 1 to 2% of the purchase. You never see it on a statement because you're not the one being charged. The merchant is. But the cost is baked into the price of everything you buy, which means you pay it anyway. The kickback just goes to your bank instead of you. None of this is a glitch. It is the business model, which means the fix is never to feel betrayed. It's to route around it. So 3 moves. 1. Move your savings to a high-yield account at an online bank or a money market fund. On $10,000, you go from earning $1 a year to $400 plus. The deposit is still FDIC insured up to the same limit. There is no catch. 2. Opt out of overdraft protection on every checking account you own. Federal law requires the bank to let you. The worst case is a transaction gets declined, which is exactly what should happen when you don't have the money. 3. For everyday spending, use a no-fee cashback credit card instead of a debit card, and pay it off in full every month. The interchange that used to go to your bank now comes back to you as 1 to 2% cashback. Skip this move if you can't pay in full. Credit card interest will eat the rewards in a single month. Your bank is not a vault, it's a toll road, and you are the traffic. Once you see the booths, you can reroute around the ones that cost you the most. High-yield savings, overdraft off, cashback on daily spend. 3 moves, no extra income required. If this made the machine a little less opaque, there's a new breakdown like it every week. Subscribe so the next one finds you. Coming up, how insurance actually pays out. Money explained plainly.